family. Listen closely because what I'm about to tell you is so far outside what most people are looking at. Everyone in crypto keeps arguing over charts, debating market cap ceilings, fighting on about supply. And meanwhile, on the other side of the world, the biggest macro-initial shift in over 30 years is exploding right under people's noses. Japan, after decades of near-zero interest rates, is experiencing a financial earthquake. Yields are erupting, capital is reversing direction, and one of the most powerful global forces, the yen carry trade, is literally breaking apart in real time. And when you actually understand what that means, you start to see a path where XRP isn't just a crypto. It becomes a liquidity tool positioned at the center of the storm. If you're new here or you love content like this, make sure you hit that like button and subscribe so you don't miss the next video. Now, let's get straight into it. Japan kept interest rates at, or near, zero for over 3 straight decades. That means the foundations of their financial system were built around essentially free borrowing. And when borrowing is free, global institutions get addicted. They borrow yen at almost zero, convert it into dollars, and invest it in anything that gives a higher return. U.S. stocks, U.S. bonds, tech, emerging markets, and yes, even crypto. This became the yen carry trade, one of the biggest liquidity engines in global finance. We're talking trillions of dollars. That flow of cheap money became oxygen for the global markets. Stocks inflated, bonds stayed strong, Bitcoin had massive liquidity waves, everything rose from that free capital. But now, the oxygen is getting shut off. Japan's interest rates aren't zero anymore. They're rising fast, 1.85% on the 10-year, 3.4% on the 30-year, 3.71% on the 40-year. For Japan, those numbers are massive. That's not a breeze, that's a tsunami. And when Japanese yields rise, institutions suddenly have incentives to bring their money home instead of parking it in U.S. and global assets. So the tide reverses. Capital flows out of the U.S., out of stocks, out of tech, out of bonds, and even out of crypto. This is something the world hasn't seen since the 1990s, and it's one of the most disruptive forces in global liquidity. But here's the part almost nobody sees coming. When the carry trade breaks down, we enter the reverse carry trade. And that's where chaos begins, because institutions that borrowed yen at ultra-low rates now need to unwind those positions. They have to sell U.S. assets, convert the cash back into yen, and repay their original borrowing. And they don't sell a little. They sell aggressively. It's not personal. It's not fear. It's simple math. And if you're serious about mastering this wealth shift, not guessing through it, then you need real guidance. That's exactly why I created Millionaire Blueprint Pro. You get the full XRP Millionaire Blueprint, the 100 times stock formula, and exclusive weekly XRP insider alerts all in one place. It's the complete package designed to give you every advantage in this market. Link is in the pinned comment. Now, let's go deeper, because this is where XRP starts entering the conversation in a totally different way. When the reverse carry trade hits, liquidity dries up, markets shake, volatility increases. Selling pressure hits assets that did absolutely nothing wrong. And institutions, they sell the most liquid assets first. That includes Bitcoin. Not because they hate Bitcoin, not because anything is wrong with Bitcoin, but because it's instant liquidity. Big money sells what they can sell quickly. But here's where the opportunity for XRP opens. In every liquidity crisis, the assets that move money fastest become the most valuable. That means tools that reduce friction, tools that settle instantly, tools that reduce FX pressure, tools that strengthen cross-border payments. And who needs those tools the most right now? Japan. Japan is not just another country. Japan is one of the biggest FX markets in the world. It's one of the largest cross-border payment hubs in the world. Japanese institutions move trillions across borders every single year, and Japan has something most countries don't: deep, long-standing ties with Ripple and XRP. SBI, One of the largest financial institutions in Japan has been publicly aligned with Ripple for years. They've invested in Ripple technology, tested digital settlement, run validator nodes, built integrations, and actively supported the growth of XRP's utility. So imagine what happens when the reverse carry trade accelerates. Liquidity gets tight, FX spreads widen, cross-border settlement becomes riskier and more expensive. Money moves slower, market stress, costs spike, and banks prioritize speed and certainty. In those moments, institutions don't care about hype. They don't care about community drama. They don't care about memes. They care about what works. And XRP was built to solve that exact problem. Low liquidity cost, instant settlement, reduced FX friction, the ability to move money cross-border with finality. This is why Japan matters so much. Japan isn't a side story. It's the epicenter of global FX flows. And when a system this big goes through a structural shift, the tools it chooses to fix the cracks don't just increase in value, they re-prick entirely. Because XRP is not a hype asset, it's an infrastructure asset. And infrastructure becomes more valuable when the system is under pressure, not when everything is calm. This is where we start getting into the mechanics of how XRP could move into double or even triple-digit territory. Not because of retail hype, not because of Moonboy predictions, but because of macro necessity. Because when a financial system requires faster liquidity tools and the asset performing that role has a fixed supply, the price adjusts upward to match the job it's expected to handle. The moment you understand why liquidity crises force assets like XRP to reprick, everything starts to click. In a liquidity expansion cycle, prices rise because enthusiasm rises. But in a liquidity contraction cycle, the opposite happens to most assets, except the ones that are structurally needed to keep money moving. That is the difference between speculation and utility. And the environment Japan is creating right now is one of the only environments in decades where utility isn't optional. It's mandatory. When liquidity gets tight, banks can't afford settlement delays. They can't afford FX friction. They can't afford multi-day capital lockups. That's not theory. That's operational survival. Think about it like this. When capital flows dry up, every extra hour that money sits idle creates risk. When FX spreads widen, every extra conversion eats into margins. When settlement times increase, every transaction becomes a potential point of failure. Institutions start looking for structural efficiency the same way a drowning person looks for air. And the system they're struggling inside is a cross-border network built on 50-year-old infrastructure. SWIFT was designed in the 1970s. Nostro Vostro accounts were designed even earlier. They were never built for a world with globalized supply chains, trillions in daily FX turnover, or instant on-demand settlement. And definitely not for a world where Japan, the second largest source of global capital, reverses a multi-dead carry trade and throws global liquidity off balance. This is the exact moment where an asset like XRP stops being optional technology. It becomes a pressure valve for a stressed system. Let's break this down with clean mechanics. When a bank moves money cross-border today, they deal with settlement risk, FX risk, capital lockup, delayed finality, high operational cost. That's during normal conditions. Now add the reverse carry trade. Add Japanese yields pushing investors to repatriate trillions. Add FX volatility, increasing the cost of every conversion. Add sell-offs, forcing rapid repositioning. Suddenly, banks are juggling money flows that are larger, faster, and riskier than they've had to handle in decades. So here's the question. What saves a system when its underlying infrastructure can't keep up? Not hype, not narratives, not retail speculation. You need a tool that rewires the plumbing in real time, something that shortens settlement cycles, eliminates FX friction, reduces capital lockups, and provides instant finality. XRP is one of the only assets in the world designed from the ground up for that exact function. And the more stressed the system becomes, the more valuable a high-efficiency settlement asset becomes. Price isn't just about supply and demand. It's about task load. How much liquidity does an asset need to carry to perform the job institutions require it to do? Utility-driven assets rise because institutions need enough value stored inside the asset to move the volumes they are expected to move. If an asset is designed to handle cross-border settlement, but its price is too low to efficiently support that settlement, the market structurally forces a revaluation upward. It's no different from how oil, steel, or electricity adjust their prices based on demand. If the system needs more of it, the price adjusts. XRP is the same, except instead of infrastructure for fuel or manufacturing, it's infrastructure for global money movement. Now, we layer Japan back into this. Japan is not a niche user. It is one of the most FX-intensive economies on Earth. Its institutions handle enormous settlement flows with the US, Europe, Southeast Asia, and Oceania. When Japanese yields rise, the yen strengthens. When the yen strengthens, repatriation accelerates. When repatriation accelerates, cross-border volume spikes. And when cross-border volume spikes during a liquidity contraction, every inefficiency becomes magnified. This is where you start to see the alignment between macro reality and XRP's design. Japan needs faster settlement, cheaper FX handling, reduced friction in multi-currency flows, more efficient liquidity corridors, tools to stabilize high-volume FX turnover, and Japan already has SBI, long-standing Ripple partnerships, infrastructure testing, regulatory openness to digital settlement mechanisms. That's not speculation. That's architecture already in place. The question is, not will Japan use digital settlement tools? The question is, when does liquidity stress force Japan to use them at scale? And stress always accelerates adoption. Think about the financial crisis in the past. It wasn't calm markets that birthed new systems. It was chaos. The 2008 crisis created modern fintech. The COVID crisis accelerated digital payments globally. Every liquidity crunch pushes the system to adopt more efficient tools. In the same way, the reverse carry trade is pushing the global FX system toward re-evaluation of its plumbing. And Japan, because it is at the center of the storm, becomes the most likely early region to scale real-world utility. Now let's talk numbers, not price predictions, but utility math. If XRP is used as a settlement bridge for large corridors, then the price is not determined by hype, but by throughput. The higher the volume that needs to be settled, the higher the price must rise to support that volume with minimal slippage. If a corridor needs $100 million in liquidity and XRP trades at $1, you need 100 million tokens. But if XRP trades at $10, you only need 10 million tokens. If XRP trades at $100, you only need 1 million tokens. Higher price equals greater efficiency. That is why settlement assets tend to climb as they become more adopted. Liquidity efficiency improves with a higher valuation, and institutions want the asset to be high enough in price that they can move large sums with minimal friction. That's why utility doesn't just support price, it attracts higher price. Now imagine Japan's settlement volume, huge corridors into the US, Europe, and Asia. Imagine high volatility in the yen, forcing frequent adjustments. Imagine the reverse carry trade unfolding not for weeks, but for months or even years. Imagine rising demand for instantaneous settlement because traditional processes are too slow and too costly during macro turbulence. Put those pieces together and you begin to see an environment where the market organically pushes XRP higher, not because people speculate, but because the asset needs to rise to do its job. This doesn't mean it happens overnight. It doesn't mean it happens in a straight line, but it means the structural forces are aligned in a way the market hasn't seen since the birth of globalized finance in the 1980s. This is not financial advice. When Japan or any major economy decides to implement XRP for cross-border settlement at scale, you're not talking about retail buyers or hyper-driven pumps. You're talking about institutions handling millions, tens of millions, and even billions of dollars every day. And the way that works is simple, but most people completely miss it. First, supply mechanics. XRP is a finite asset. That means when banks and institutions lock XRP into custodial wallets, liquidity pools, or corridor accounts, those tokens are removed from the circulating supply. They're not trading on exchanges. They're being used as the plumbing for real capital flows. When demand rises but liquid supply shrinks, the natural effect is a structural increase in price. It's math, not hype. And when you layer institutional demand on top, you get something even more interesting. Sticky demand. Sticky demand means institutions aren't buying XRP for a quick flip. They're buying it to move money efficiently, to reduce FX friction, and to guarantee settlement. They hold, they use, and they continually need more as transaction volume increases. That creates a natural floor under the price which isn't based on speculation, but on necessity. The higher the stress in the financial system, the more they need these assets. And as more corridors open, as more institutions adopt XRP for settlement, the floor rises further. This isn't guesswork. It's macro logic applied to real-world infrastructure. Let's break down what happens as adoption grows in tiers. Tier 1, light corridor testing. You might see a handful of Japanese corridors open using XRP for small-scale settlement, maybe a few $1 million a day. That alone could move the price consistently into the $3 to $7 range. It's the training wheels phase. Proof of concept, low friction, and minimal risk for the institutions involved. No hype cycles needed, just basic utility driving natural demand. Tier 2, medium corridor adoption. Now multiple corridors start using XRP for cross-border flows. FX stress is present. Settlement speed matters and banks begin to realize the operational savings. At this level, XRP's price could realistically sit between $10 and $30, depending on corridor volume and liquidity needs. This is where adoption starts to compound. As more institutions integrate XRP, the market begins to recognize it as not just a crypto, but a critical infrastructure asset. Its structural demand, again, sticky, long-term, and resistant to retail-driven volatility. Tier 3, heavy settlement integration. Picture Japan using XRP for significant liquidity support, multiple corridors running large daily volumes, and banks leveraging XRP to reduce systemic risk. At this point, XRP behaves less like a speculative asset and more like a core financial tool. Price could adjust naturally into the $50 to $100 range. It's not a moonshot in the traditional sense. It's a structural revaluation. The math of liquidity, supply, and institutional usage drives the market, not retail sentiment or FOMO. Tier 4 extreme scenario. Now, I want to be very clear. I'm not saying this will happen, but we have to consider the theoretical upper bound to understand the full picture. Imagine a major liquidity crunch hits, global FX stress intensifies, and XRP becomes the primary solution for settlement corridors under extreme pressure. Institutions and banks need fast, reliable, low-cost settlement tools at unprecedented scale. The market dynamically adjusts to ensure that XRP can handle the volume. In this case, triple-digit valuations become mathematically plausible, not because anyone is guessing, but because the underlying system demands it. What's critical here is understanding the difference between retail speculation and institutional necessity. Retail-driven hype spikes are short-lived. They come and go with emotion. Utility-driven adoption is persistent. Institutions aren't chasing green candles. They're solving operational problems. When liquidity stress exists, the system doesn't care about memes. It cares about efficiency. XRP was designed for this exact purpose. It is at its core a liquidity asset for high-volume, high-speed cross-border settlement. And when you overlay the macro environment, Japan exiting decades of zero interest rates, the reverse carry trade, forcing liquidity repatriation, FX stress amplifying operational risk, you start to see why XRP is uniquely positioned right now. This isn't about predicting price. This is about seeing the forces that could necessitate higher valuations. As corridors multiply, FX stress continues, and institutional adoption rises. XRP's structural demand compounds. Supply contracts further because locked XRP is taken out of circulation. Demand is sticky because institutions don't sell once they acquire XRP. They use it to settle transactions and maintain liquidity corridors. The result is a system where the price floors are no longer driven by speculation, but by macro necessity and institutional usage. And that is where the real XRP math comes in. Finite supply plus sticky demand plus utility-driven adoption equals structural revaluation. And if you really want to understand this wealth shift, not just watch it happen, the Millionaire Blueprint Pro is where you want to be. I put everything into it. The full XRP blueprint, the 100 times stock formula, and my weekly XRP insider alerts. It's the all-in-one package designed to help you make smarter moves with way more confidence. The link's in the pinned comment.